Hi guys, welcome back to Marantz. Rants, plenty of good information, a little bit of motivation, a whole lot of truth, no financial advice. I always talk about GameStop's balance sheet, and I always say it's so strong. And then other people say, "Oh, it's a strong sheet," but there's other things. And I'm like, nah, don't trivialize it. Like, actually give it the clout that it needs and the recognition that it needs, because it's that good. And I'm going to prove it to you today because we're going to go over some sheets. And as we go over these other companies, guys, it's a longer video than normal, and I apologize, but it's because I want you to understand just how great GameStop is. They have a balance sheet, they have cash on hand, they're doing the better business model without offering up their company, and that's the best part about it. Shareholder equity is not going to be leveraged so that the company can perform, with optics. It's not that way. So let's go ahead and look at some companies, let's go ahead and look at some stocks, and let's get this going, okay? If you guys like numbers, this is your video. Here we go. First is gonna be GameStop. Obviously, I love this company. 1090, right? The inventory ratio right now, the turnover ratio is operating at around 6.0, one of the best ever in the history of GameStop. Ever since Ryan Cohen's been there, they've been over 6, 2 times now, and that means a lot. If you guys don't know, cost of goods sold divided by the average inventory on hand, that is your turnover ratio. Your inventory turnover ratio matters, certainly in, I guess, retail. When you think about consumer index, they actually consumer discretionary stocks and companies, they trade at around 3.4 is their average on turnover ratio. As you can see, GameStop's with the big boys, Best Buy 6.7, Target 7. I believe they're beating Home Depot. Home Depot's lower than GameStop. They're not even at a 6. Walmart's at a 10. Costco's at a 14. Yeah, I get it. But GameStop's on par. That was the point. And GameStop didn't offer their company up, right? The equity of the company, they didn't borrow money. They don't owe money via bonds or anything like that. There's no covenants that are restraining this company from doing anything. The part that was really tricky for me on GameStop's balance sheet is it looks like they have enough cash to start up another GameStop. Like, that's how much money they have based off of what the company costs. The property and plant and equipment total is $650 million. Well, they got double that. So I'm ready to see what GameStop can do with the shareholder equity that they currently have, but they have not lost shareholder equity over the last 4 years. In 2019, just to give an example, shareholder equity was at 1.3. I'll even show it to you. 1.34 right here. 1.34 total equity. Okay. If we go to 2019, that's 2024 right now. 2019 right here, shareholder equity, that's 2020. No, 2019, 1.34, the same. So not only do we have the same amount of equity from 5 years ago, we're doing it operating at a better rate because we're not losing money. They weren't a profitable store then, they are a profitable store now. But let's go look at some companies that GameStop has to get ahead of based off of what the market cap is. Market cap of 3.33 billion is embarrassing considering what the value is of this stock. I always talk about book to price to ratio, the book to ratio, as far as price to book. The words out. No edits, no cuts. But the price to book ratio is around 2.4, 2.5. And that means that you're getting about 40% equity right now on a GameStop share. And no other company operates this way. Or there are some companies that have a better book ratio. And I was asking myself, who has better book ratio than GameStop, and why, and how can we go look at it? Then I started looking at all the companies in front of GameStop to get into the S&P 500. I said, oh, I get it now. I see what these other companies had to sacrifice to get there. But let's go ahead and go over it ourselves, guys. Don't forget, $4.38 of every share of GameStop is book, meaning shareholder equity. That's a phenomenal number compared to the stock price today. So let's go ahead and look at the first company up to bat. We'll go to Macy's, right? Macy's, widely known, one of the most famous companies in the history of the world. They've been around for 100 years, and I've seen Macy's go bankrupt twice. And not only did they go bankrupt twice, I saw private equity sweep in and carve out assets, right? May Company, Robinson's May, Macy's that you see today, Macy's Inc. And when you see Macy's, they have a book price to book ratio of 1.31, which is 2 times better than GameStop. They have all the value in the world. $15 of that share is equity. So right there, Marantz, this is the best company I could buy. I should be buying Macy's for $15 book and $19.99 what it is, the price. And why? Because look at this sheet. This is where it's at. It's finally picking back up. You saw it run up, but if you know what the run-ups are, this is why you got to know the story of what it is, right? So the story of Macy's is that private equity is offering money to buy in. And they're willing to buy in because there's $7 billion worth of assets on this damn thing. So when I go over here and I look at financials and I see what they're actually giving up, you see that Macy's has $1 billion cash. GameStop has more cash than Macy's. Macy's a massive company, $16 billion worth of assets. And guess what this company sells for? $5.46 billion worth of book or market cap. And people say, well, there's no way. Look at the assets are worth more than the damn market cap itself. Well, there is a way, and I'm going to show you why. Because Macy's, which sits heavy on inventory, over $4 billion worth of inventory, but they also have right here the property, plant, and equipment, $7 billion. So of course people want to get there and carve at those assets. And when I looked at them, the goodwill wasn't an issue. 800 million, it's fine. But when you see liabilities, what did it cost Macy's to have $1 billion in the bank? Well, it cost them $3 billion to borrow. So they borrowed $3 billion. That's a long-term debt. And then that's the shareholder equity. So that's what's propped up. But there's more to the story than that. You just can't go, okay, there's the story of the balance sheet. Let's talk about the income statement. This is where people need to understand, projections, multiples, and foresight. And this is why we read GameStop sheet so in depth. Macy's operates at a profit, $248 million worth of profit. Guys, that dwarfs GameStop's number. But is it really that great? Absolutely not. I'll tell you why. 2 years ago, Macy's used to make $2 billion in profit. They've lost almost 90%. They've lost over 85% of profit over these last 2 years. They've lost all their profit. This is why private equity is knocking on the door, because that's going in one direction. And I'm not talking about Harry Styles and the boys. I'm talking about one direction all the way down to the ground. This is why Macy's has lost all their value. To go from $34 a stock all the way to 11, losing 66% of the stock within 1 year. Now you're sitting here in 1987, propped up off the idea that private equity is going to buy you out. That's all this is here. But yes, 248 million. I mean, wouldn't you be heartbroken as an investor if you went from 1.66 billion, which is the number there for actual equity and revenue, I should say, operating income, 1.66 billion down to 248 million. We have a problem. Houston, we have a problem, and that is Macy's. Let's look at Bed Bath & Beyond Body Works. Their market cap is $10 billion, which blows my mind. $10 billion, private equity run and owned. And when I looked at it, they have a negative book value, negative price to book ratio. And it kills me because look at the revenue. You look at revenue right here. We'll look at the income sheet. They actually operating income, $1.3 billion of operating income. They make $1 billion in operating income. Everybody say it with me. That's $1 billion. It's not a bad thing, is it? What did it cost you? What did it cost you? Go ahead and look at the actual balance sheet. It's very hard to go positive. I want people to know this. It's hard to become a profitable company and stay positive, all while not selling your soul to someone. Because when you look at this balance sheet on assets, they have $1 billion of cash and cash equivalents. So they have $1 billion. They have $5 billion in assets. But do you know what their liabilities are? Their liabilities, guys, are $7 billion. They have more liabilities than assets, and that's because they owe $5 billion in long-term debt, $4.39 billion. Almost like AMC, what they owe. But I tell you, it's not that bad. Maybe these guys can service this debt over time. But shareholder equity, negative $1.63 billion. $1.63 billion for the shareholder equity, negative. They got that down from $2 billion the year before. So hopefully these guys can outperform whatever they had to do to stay alive during the pandemic. But I see a sheet that's upside down. Remember, they don't have shareholder equity. They have shareholder deficit. That's them. Let's go to Wayfair. Wayfair's sitting on $3.47 billion worth of assets. You see the stock price. You see the volume. Market cap is double what GameStop's is. Yeah. Cash, they've got $1 billion. They got $1 billion worth of cash, guys. And when I looked at with cash, what did it say? 1.3 billion. There you go. 1.3. Very similar to GameStop. Right there on par. And let's see how they got there. Let's see what they had to do to get to 1.3. Well, I'm going to look at it myself. Liabilities, by the way, their assets are $3 billion, $3.47 billion. Liabilities, $6 billion. Almost double the other way. Long-term debt, $3 billion. So you borrowed 3 to have 1 on the books. Shareholder deficit of $2.71 billion. Don't believe the nonsense, guys. They have increased their shareholder deficit $200 million. They lost $200 million last year. It gets worse for Wayfair. It doesn't get better. They're 2 for 1 in the opposite direction. This is why GameStop's sheet is so clean. Let's go ahead and look at a company like Carvana. A lot of people like to pay attention to Carvana. I tell you, Carvana finally showed a profit. I don't care how they did it. And I was just like, wow. So they didn't pay their bills because I knew what happened on inventory. If you looked at inventory, they shrink their inventory almost $600 million. Over $600 million. They shrink their inventory. So they didn't buy more cars so that they could actually show a profit for the year. What do they sit on? $7 billion worth of assets, and they have $500 million worth of cash. Well, they also have $7 billion worth of liabilities and long-term debt, $5.42 billion. They borrowed $5 billion to have $500 million on the books. Their negative equity or their shareholder equity is at $243 million. So total equity negative 384, shareholder equity 243. $243 million worth of equity is what they have for a company at $7 billion. Means they have no equity at all. Price to book is 66. It's not even there. $1.21 is equity out of the $81 a share. That price should not be there. If that's equivalent to GameStop, it should be a $3 stock, Carvana, based off of the way they operate. But the income statement tells you that. Operating income went from negative $3 billion all the way positive $175 million. I can tell you how they got there, but you're not going to like it. You're just not going to like it. This is not a chart that I would buy into or a company I buy into. Penske Automotive, they are above GameStop. They have a $10 billion market cap. You guys, watch this. Price to book, 2.13, better than GameStop. Their cash on hand per share, their equity per share is $70 per share. Look at the price. $70 per share is equity. Look at this chart. It's phenomenal. Is it? Let's go find out together. Income is going to be $29 million, $29 billion. I apologize. I'm reading it for what it is. Operating income of $1.3 billion. Phenomenal. Little down 9% from year over year. Let's see what it cost them and how they got there. $15 billion worth of assets, a cash on hand, $96 million. For a company that's doing $30 billion in sales, essentially, and $15 billion in assets, they only have $96 million cash. What does it cost you guys? I'm trying to tell you something here. Let's go ahead and look at it. They're asset heavy. They're rich on property. $5 billion there. Goodwill of $2.2 billion as well. Liabilities of almost $11 billion in liabilities themselves. So it's a propped up sheet, and long-term debt of $1.42 billion. So what does this tell you? Shareholder equity of $4 billion. Tells you they have no cash whatsoever. These guys are operating at the edge. I guarantee you, those executives at that company, Penske Automotive, which is all private equity owned, by the way, they're giving themselves bonuses. They're paying out dividends. They're doing everything they can. They just operate and float $100 million. That's what they do. That's a risky business to run. $100 million is all you are, because you know what? You know you're asset heavy. You know you're rich. So yeah, they make money, but they don't have the money to show for it. So it's really weird. It's a weird business model. Do I think it's worth buying? Not for me. Let's go look at the chart. Yeah, that chart's crazy. It's crazy. But hey, they have numbers to prove it. I just don't like the way they do it. $96 million? Nah. Lowe's. You guys know Lowe's. All-time high. Look at this Lowe's. Amazing stock to buy. Apparently, I should be buying this damn thing. Income statement. Operating expense, total revenue, $86 billion. They operate an income of $11 billion. They make $11 billion, guys. Hey, $11 billion is what they make a year. How much cash they got, guys? Say it with me. Less than GameStop. Less cash than GameStop. Assets, $41 billion. Total inventory is $16 billion. Assets, current assets, buildings, and property equipment, 22, essentially. And liabilities of $56 billion. So they have a net, oh, by the way, long-term debt. They owe, no way, $34 billion. $34 billion worth of debt. Shareholder, total stockholder equity is negative $15 billion. Oh no, Marantz. They make money. They make $11 billion. Yeah, well, their also shareholder equity is negative and a deficit of $15 billion. Should that stock price be where it's at? Should the market cap be where it's at? Absolutely not. Whoever's running this sheet in this company is leveraged like you wouldn't believe, and the cash is embarrassing. Less than GameStop on cash. So that's where I'm at with them. AutoZone, $3,000 a share. Oh man, what a phenomenal company. Total assets 15, 16 billion. And when I look at this property, that's where all the assets are, 8 billion. Sure. Burning it away. Liabilities, 20 billion. So what the hell? How the hell did this happen? Oh, there it is. They borrowed $7 billion. That's what they owe on the books. Long-term debt, $7 billion. They have a shareholder equity of negative $4 billion. Oh, $3,000 a share. Market cap of $52 billion. They're negative $4 billion of shareholder equity. Maybe I'm just mistaken. Maybe I don't see it. For a company with a fat sheet like the way they have it, they have cash on hand, $270 million. I know when private equity is in a company, I can see it. Can I show you guys something about Alibaba? Like, I'm just going to give you this example. This is the first one that I saw. I go, holy hell, that's amazing. Price to book ratio 1.32, phenomenal. Actual cash per share, equity per share, 55.89 versus 74, phenomenal. Cash on hand, 193 billion. I'm so sorry, $500 billion on cash and cash equivalents and short-term investments. $500 billion, $500 billion. They have equity. You go and look at their liabilities, that can almost pay their whole liabilities. GameStop can pay their whole liabilities with their cash. But shareholder equity, almost $1 trillion. Shareholder equity. Is that a company you should be buying? Yeah, probably. Alibaba is severely undervalued right now, from what I can see. Income statement tells me operating income of $100 billion a year. Look at the chart. Look at this chart. From 315 all the way down to nothing. And you're going to tell me that what should you be buying? Maybe we shouldn't trust the Chinese numbers, right? Is that what they told me? I'm just letting you guys know. This Walgreen Boot Alliance, look at this thing. All the way down to the ground, which it should be. But still, $15 billion worth of market cap in the S&P 500. The price to book ratio, 1.16 billion. Out of that $18 worth of stock right there, 15 of it is shareholder equity. Let's go look at the chart. Operating income, negative $5 billion. From 1.72 to negative $5 billion. Must be a misprint. How much cash they got? Less than GameStop. They got almost $100 billion worth of assets. Doesn't matter. All the shareholder equity in the world of $20 billion in shareholder equity, and they owe $8 billion right there on the books itself. But is this something that I would buy? No. Propped up on goodwill of $28 billion. It's just not what it is, guys. These companies that are not operating the right way or at the right ratios. Why do I talk about it? Why don't you talk about it? My point is this. GameStop has $1 billion of cash, okay? And they're headed in a different direction than all the other companies. Aside from Alibaba, which should not be down where it's at in value. It should be going the opposite direction. They have $1 trillion worth of shareholder equity. That's crazy, right? So market cap should be wild too, but I'm telling you guys, when I look at GameStop and they are sitting on $1 billion, $1.2 billion, they literally could open up another whole GameStop with 3,000 stores, go that whole route, because that's the infrastructure that's built here. Based off of their expenses, their liabilities, they can pay them all with the cash they have on hand. So whenever you want to dream about how big GameStop can be or what it could be or where it should go, sit back, sit tight, and watch it happen. Because it's going to. But they're going to scale properly. And that's what's happening right now in the stock. I just wanted to give you guys a rundown, let you guys see just how ridiculous some of these sheets are, that the companies that are above GameStop and beating them, they have no cash. They have no safety net. They're riding in the wind. And maybe they'll find out exactly what this economy is going to bring to the table on them. But GameStop has runway. None of those guys have runway. All those guys have is one way to bankruptcy and or to private equity sweeping in and leveraging them and carving out assets, which most of those companies I showed you are already that. GameStop's not that. This is why I invest. This is why I love it. Hopefully you guys like the price. Hope you guys like the video. I got to get going. I appreciate everybody here today. I didn't go live, none of that. I'm just here to make a video and get out the door. GameStop has all the value you knew it always would. And right now, $1.2 billion worth of cash, all the shareholder equity in the world. I know exactly what it is. Well, it's priceless.